everybody? According to Fannie Mae, the leading source of mortgage financing in the United States, home sales are expected to fall 16.2% from a year ago, a downward revision from their 15.6% forecast in July. Housing remains clearly on the downtrend and has been for several months now due to the combined effects of outsized home price increases and the significant and rapid run-up of mortgage rates, said Fannie Mae Chief Economist Doug Duncan. Today we're going to take a look at this article from Inman to see how this information affects home prices, inventory, and ultimately the future of the housing market. Are less homes selling but more homes sitting on the market, which could create more inventory? As I've said in my previous videos, we need a huge influx of inventory all at one time to really create a housing crash. So let's see if the data helps us decide if we're really heading for a housing market crash, or is the housing market just going to continue to slow down but not actually crash. We'll also look at present data from Redfin and Realtor.com that show a very different trend that all these articles and videos about housing crashes are suggesting. While we're all feeling the housing correction now in September of 2022, is it possible that the market could shift and start to pick up in the fall, or will we continue to feel the correction towards the end of 2022? Well, let's just dive right in. Take a look at this chart provided by Inman and Fannie Mae. In projections released Monday, forecasters with Fannie Mae's Economic and Strategic Research Group said they now expect 5.78 million homes to exchange hands this year. That would represent a 16.2% decline from a year ago, a steeper drop than the 15.6% forecast from July. Despite a pullback in mortgage rates over the past month, recent incoming data point to a faster near-term slowdown in sales than we expected, especially for new homes, Fannie Mae forecasters said. New homes sold at an annualized pace of 590,000 units in June, the lowest sales pace since the recovery from the first COVID outbreak, prompting Fannie Mae forecasters to cut their outlook for new home sales to 632,000 units, down from 668,000 in last month's forecast. This is not good news. There has been a lot of negative builder sentiment, which has really caused builders to slow down. According to CNBC, builder sentiment in the market for single-family homes fell into negative territory in August as builders and buyers struggle with higher costs. The National Association of Home Builders Wells Fargo Housing Market Index dropped 6 points to 49 this month, its 8th straight monthly decline. Anything above 50 is considered positive. The index hasn't been in negative territory since the very beginning of the COVID pandemic for just a little bit. Before that, it hadn't been negative since 2014. And as far as existing sales, they're also expected to fall by 16% to 5.143 million. In January, before this year's big run-up in mortgage rates, Fannie Mae economists were projecting that the sales of existing homes would fall by just 3.2% this year to 5.945 million, which still would have been the second best year since 2006. Sales of new homes projected to grow by 14.9% to 885,000, as builders were expected to put more homes that were under construction on the market. So this is a major shift from the beginning of the year, which is obviously a result of the higher mortgage rates that happened because the Fed Reserve wanted to battle inflation, so they started raising rates. Which brings me to the question I get asked a lot these days. Where do I think mortgage rates will go? Will they continue to go up, or are they going to come back down? According to Inman, Fannie Mae economists think mortgage rates have actually peaked and will trend downward going into next year. Fannie Mae forecasters expect the Fed to modestly slow its pace of tightening by increasing the funds rate by 50 basis points instead of 75 at its next meeting in September, and for the benchmark federal funds rate to peak at around 3.4% by the end of the year. Rates have been dropping slightly lately, and if you look at this chart from the Mortgage Bankers Association for 2022 Q4 going into 2023, they are projecting rates to go down even more. However, Fed Chairman Jerome Powell has said the Fed will be relying less heavily on policy guidance and be more data dependent going forward, meaning the risk of more aggressive tightening remains if inflation and job growth remain strong. So I guess we'll see. see. If inflation settles a bit, maybe rates will continue to go down. If it gets worse, the Fed will jump in and they'll go back up again. Let's take a look and see what they're saying about home prices. As we all know, the biggest hurdle for buyers right now is affordability. While annual home appreciation has slowed down, prices haven't gone down as much as Fannie Mae forecasters thought at the beginning of the year. In January, Fannie Mae economists projected that home price appreciation would drop down to single digits by the third quarter of 2022. In their latest forecast, they don't see that happening until the second quarter of 2023, where they expect home price appreciation to drop to 7.8%. If you look at Fannie Mae's chart, they expect home price appreciation to go to 4.4% by the end of 2023. So they are still predicting home price appreciation, but at much lower levels. Now remember, I always say real estate is very localized, so what's happening here where I am in the DC area is very different than what's happening in Boise or Austin or anywhere. We know from previous videos that I've done that there are many areas in this country that are seeing much more drastic price reductions than what Fannie Mae is projecting nationally. But as long as inventory is tight, prices are going to stay high as long as buyers can afford to get back into the market and pursue home ownership. We expect overall for-sale inventories to remain tight for the foreseeable future, with some relief coming from the eventual completion of new homes as move-up buyers will vacate their existing homes, Fannie Mae forecasters said. We expect the future completion of new homes will contribute to slowing house price growth and help with affordability. I'm not sure we want to depend on builders to create more inventory because we know that builder sentiment is down due to higher costs and more resale inventory. I want to pivot a little bit and look at Redfin and Realtor.com's data on the housing market to see where the trend is going. We're not going to look at it all, but I thought some insight on prices and inventory was important as we head into the fourth quarter of 2022. For Redfin, this data is for the week ending August 25th. Active listings for sale are up 4.3% year over year, but look at this chart and you can see that the line has dipped as active listings fell 0.6% from the prior 4-week period, the biggest decline since January of 2022. Now let's look at Realtor.com's numbers because they get even more granular and more specific. You can find this data if you want at Realtor.com/research/data. If you look at the active listing counts year over year, you can see that active listings are up 26.2% from this time last year. This is definitely trending in the right direction. Take a look at just a few months ago in April when inventory was down 13% from a year ago. As interest rates rose, buyers took a step back. Either they were priced out or they're waiting on the sidelines, so inventory increased. The big question is, will inventory continue to go up and help balance the market? And will it go up even more and all at once to crash the market? Well, take a look at the last few weeks. This trend is telling us otherwise. In July, active listings were up over 30% since last year, and that number has gone down week over week for the last 3 weeks to 26.2% for the week of August 20th. So there are less active homes on the market week over week for the last 3 weeks, which is not trending towards more inventory. Also, if we look at new listings on the market as of August 25th, new listings of home for sale were down 15% from a year earlier, the largest decline since May of 2020, according to Redfin. According to Realtor.com, that count was down 12.2% from this time last year. This number has increased since July 16th, week over week, except for the week of August 20th. And the number of days that homes for sale were on the market was a median of 25 days, up from 21 days a year earlier, and the record low of 17 days set in May and early June. According to Realtor.com, the median days on the market has increased week over week since July 23rd from 0 to 4. And as far as price reductions, according to Redfin, on average 7.7% of homes for sale each week had a price drop, a record high but unchanged from the previous 4-week period. But look at Realtor.com data, which breaks it down week over week. The percentage of price reductions has gone down from 112.3% in the week of June 18th to 66.8% the week of August 20th, consistently week over week. So 66.8% 40% of homes had a price reduction compared to this time last year, but less homes are having price reductions week over week for the last 10 weeks consistently. So what does all this tell us? If we were heading for a housing market crash, we would need a lot more inventory and not less. And as we've shown you today, both Redfin and Realtor.com are showing less inventory from both active listings and new listings coming on the market. Also, if we were heading for a crash, I would think that we would see more and more price reductions week over week, with that number increasing, not decreasing. Now, the lessening of price reductions, it could simply be that sellers have finally adjusted to the changing market and are pricing their homes more appropriately. We need more data to determine the real reason for the decrease in price reductions. So the bottom line, and let me know if you agree with me, is that I just don't think we're heading into this big housing market crash that a lot of people are talking about. A correction? For sure, we're already feeling it, but that's good to bring about a more balanced market. Things to look out for, in my opinion, are unemployment numbers, new construction numbers, foreclosure numbers, and interest rates. If unemployment increases, builder sentiment decreases, the number of foreclosures increase, and interest rates continue to go up, then yes, this could definitely get a lot worse. But for now, I'm still hopeful that we're experiencing a much needed correction to create a more balanced market. We're not going to go back to 2008, and we're not going to have a housing market crash. If you got some value out of today's video and you'd like to show our channel some support, please consider smashing that like button, commenting below, and subscribing to our channel. It definitely motivates us to make more videos. I really try to bring you guys the most up-to-date information from all the different industry insiders so you can make the best decision for you and your family. And if you want to see more of my housing market forecast videos, definitely check out these two. They're all from different industry insiders, so watching them all can give you a great sense of what we all think is going to happen in the housing market. Thanks for watching. I do appreciate it. Bye!